All right, we'll now provide an update on thin capitalization and the DDCR. I'll just quickly stop here. Does anyone have any questions on Pillar 2? And editor here, name. All right, progress update on the thin capitalization and the debt deduction creation. So the new thin capitalization changes applies from 1 July 2023 to a set we call general class of investors. Banks, authorized deposit institutions, they continue to use the existing calculations. So under the new rule, the net debt deductions of taxpayers are limited to 30% of tax earnings before interest, depreciation, and amortization, fixed ratio tax. Groups can alternatively choose to apply two other methods. One is the group ratio, it is obviously greater than 30%, but experience indicates that it's rarely used, especially by subsidiaries due to information access constraints. The other one is a third-party debt test, but you can only apply this to, broadly speaking, third-party loans. So you cannot use it with loans with your parent company. The only way you can make this choice is to use the recently released ATO approved form. So that, remember, that's the only way you can make the choice. Under the fixed ratio test, if you have net deductions denied, it may be carried forward for 15 years, provided that you satisfy certain recoupment tests. You may also potentially recognize a deferred tax asset on these denied deductions, provided that you can satisfy the recognition criteria in WSB 112. I'll just repeat this track here. If you switch from the fixed ratio test to the other methods, any brought forward denied deductions would be lost. So just be aware of that trap. Also, another potential trap is to assume that because I don't reach the 30% of tax EBITDA threshold, my interest deductions are fine. Right? Yang Shi, when he presents, will demonstrate to you that interest can still be denied under the transfer pricing rules because it takes precedence over the thin capitalization rules. And also, there is a new debt deduction creation rules, which applies from 1 July 2024. So what does this rule do? It restricts interest deductions on two types of related party loans. One, the loans is used to acquire a CGT asset from another related party. Now, CGT asset, you think shares, property, right? Land, buildings, is broader than that. CGT assets includes stock, includes WIP, includes intangibles, includes plant and equipment as well. So be careful of that. The second type of loans caught by the debt deduction creation rules is if you use the funds to make certain payments that are listed in the legislation and will also be listed in the regulations. And what sort of payments are caught? If you borrow money from a related party to pay dividends, to undertake a buyback of shares, to reduce capital, to return capital, and even to make royalty payments to related parties. And you also note that the term royalty is wide. Just because you don't call something a royalty does not mean that it is not a royalty. So be wary of that. So those things are caught by the debt deduction creation rules. So what has changed since our last update? As a result of the introduction of the thin capitalization provisions and the debt deduction creation rule, we have seen groups undertaking a restructure of their financing structure. Therefore, you can see the ATO releasing PCG, Practical Compliance Guidance 2024 D3, which allows you to rate restructures that are undertaken as a consequence of the introduction of ThinkCap and the DDCR. Before I go into the risk rating, it's important to note the reference record keeping in the PCG, which I think is important. The ATO says, hey, the onus is on you to trace the loans to prove that the debt deduction creation rule has not been triggered. And these are the documents that you should be looking at to trace those loans. And that includes the loan documents, the financial accounts, your GL entries, your payment records, your bank statements, and what you said in your board resolutions. So these things you need to consider. Also, simple apportionment does not replace tracing. So you may be required to actually trace how the funds flowed and how they were used. So our recommendations to clients are, firstly, there's no grandfathering. If the loan is still in existence, even though it was created 5 years ago, it is still caught by the debt deduction creation rules. For these loans, we recommend that you create a DDCR file and actually trace how the funds were used to determine whether the debt deduction creation rule is triggered. For new loans or increases in related party loans, we recommend that you contemporaneously document how those funds were used. Also, this PCG would be included in the reportable tax position schedule disclosures. Okay, now we'll talk about risk rating. So in the PCG, the ATO provided examples of what restructures they regarded as low risk and what they regard as high risk. So in relation to the debt deduction creation rule, a restructure that reduces the loan and doesn't increase it again is generally regarded as low risk. So in this example, OSCO previously borrowed from BICO to acquire a CGT asset from BICO, so classic DDCR transaction. It also entered into interest rate swap arrangement to hedge the interest on this loan. So that is also caught by the DDCR. As part of the restructure, BICO injected equity into OSCO. OSCO then used the money to repay BICO. The interest rate swap is terminated. That's regarded as a low risk restructure. No new debt created. A high risk restructure is one where it's covered by example in a PCG. That means it's similar to the example, or the ATO has undertaken a review of your group and has identified the restructure as high risk. So that's a high risk restructure. So generally, it's high risk if you got debt deductions that are subject to a DDCR. You do something, still have the same amount of debt deductions, and then you say these deductions, this new set of deductions is not subject to the DDCR. So let me give you an example of that. Same example from previously. Instead of equity injection, OSCO borrows money from an external bank. So it says, well, this is no longer a related party loan, so the DDCR does not apply. It used the funds to repay the debt to BICO. Not sure how important this leg is. BICO then used the funds to repay its debts as well. And the interest rate swap is terminated. The amount of debt deduction in OSCO remains the same, regarded as a high risk restructure. Okay. In relation to thin capitalization, I'll give you an example of a low risk and a high risk restructure. So in thin capitalization, you recall the debt deductions is limited to 30% of tax earnings before interest, depreciation, and amortization, EBITDA. So here you got one company with a high tax EBITDA, and then you got another company in the group that has a low or zero tax EBITDA. You decide to restructure, form a tax consolidated group, and for tax consolidated group, you do your tax EBITDA calculation on a group basis, right? That is fine. That is regarded as a low risk restructure. A high risk example is a company. It realized, geez, I can borrow a lot more money before I trigger the 30% threshold. So what I'm going to do is the group undertakes a round robin transactions, and that is moved into Australia, but it doesn't really change the business of you don't buy new assets or anything. That is regarded as a high risk restructure, right? Obviously, it's different if you borrow money to buy assets in Australia. Okay, so this is where you round robin transactions that moves that into Australia. That is regarded as high risk